So the name of the insurance company is Insurance, Southern Insurance Corporation. And the date given to us is 31st Form B. We call this Form BBS. BS stands for balance sheet. There it was Form B RA revenue account and Form B PL profit and loss account. This is Form B BS. BS stands for balance sheet. Balance sheet as on 31st March 2016. That's the date given to us as on 31st March 2016. So before we start this, we need to do our schedules. So directly I move to schedule 1. Directly I move to schedule 1, which is share capital. Sorry, not schedule 1, schedule 5. Schedule 5, which is share capital. Okay, and here, normally when I told you when you do this schedule, normally we write the authorized capital. Normally we write the authorized capital. Now in this problem, they have not given us the authorized capital. So I'm just going to put a dash. I don't know the authorized capital. We normally write it because it is part of the format. You show the authorized capital and then you show the issued, subscribed, called up and paid up capital. So the next we have is issued, subscribed, called up and paid up capital. Okay, now here this is given to us in the problem. They've told us the share capital. There are 2 lakh equity shares of rupees 10 each, fully called up, fully called and paid. Okay, and the amount here is, now be careful, the amounts are given in thousands. So even if 2 lakhs into 10 is 20 lakhs, we don't write it as 20 lakhs, but we are writing it as thousands because that's the figure, that's how the figures are given to us. So that is schedule 5. Next we have schedule 6. We've already discussed what goes in the schedules, reserves and surplus. Reserves and surplus. So the first thing that we have there is the contingency reserve. The contingency reserve given to us is 400. Then we also have general reserve. The general reserve given to us is 1,200. And we have another one, that's a profit and loss account. Yes, profit and loss account credit balance. Profit and loss account. If it's a debit balance, it's a separate item in the balance sheet. But if it's a credit balance, it comes as part of reserves and surplus. Profit and loss account is 300. Now we have another item called investment reserve. I told you investment reserve is not taken in reserves and surplus, but it is adjusted in this so-called fair value change account. Okay, so don't confuse it here. I will explain what this investment reserve is when we are doing that fair value change account. So the total here is 400 plus 1,000, 1,900. The total is 1,900. Next we come to schedule 7. Do we have anything under schedule 7? Yes, we have some borrowings. Schedule 7. Borrowings. Now what are the borrowings? What we have identified as borrowings. One is the public deposits. Public deposits, which is 1,000. And we also have bank loans. Borrowings are basically where the company has borrowed money, either from banks, from other financial institutions, or raised money by issuing deposits. So bank loans, which is 2,000. So the total here is 3,000. Schedule 8. Fair value change, I said, is a working note which we do towards the end. Okay. Right now we are going in the order of schedules. Schedule 8 is investments. Schedule 8 is investments. Now, with regard to investments, we just need to be a little careful. First, we'll just mention what investments have been given to us. They have investments in government securities, investments in government securities, which is 2,400. Then we have shares and debentures of joint stock companies, shares and debentures of joint stock companies, which is given to us as 1,500. Okay. Now this total comes to 3,900. This total comes to 3,900. I'm not going to complete this note yet because with regard to investments, if you remember, there's an adjustment which says market value of investments on that date was rupees 36 lakhs. Okay, so basically the book value of the investments is 39 lakhs. Why I'm calling this 39 lakhs because these figures are given in thousands. Okay, so the book value is 39 lakhs, but the market value is 36 lakhs. How to show it? We will do it. We'll come back to this schedule a little bit later once we do our fair value change account because that is linked to this. Okay, so right now what I'm doing, I'm just writing and keeping what is given with regard to the investments. We will complete the schedule a little later. The next one that we have is schedule 9, which is loans. And under loans, we have mortgage loans. We have mortgage loans. The amount is 1,300. And there is also loan on company policies, which is 700. Loan on company policies 700. Total is 2,000. Schedule 10. We just have one item here, that is, this is fixed assets. I think just one item here, which are premises. And the premises total given to us is 1,500. There is no depreciation given in the problem. If there was depreciation, we would have minus the depreciation accordingly. Now we move on to those bifurcations. Schedule 11, which is cash and bank balances. I think we have one item here which is cash in hand. The first item given to us, cash in hand. That's the only item, 3,600. Then we have schedule 12, advances and other assets. Under advances and other assets, we have deposit with electricity board. Deposit with electricity board, which is 100. Then we have agents balances. I told you agents balances can either be a debit or a credit. If it's a debit balance, it comes under advances and other assets. If it's a credit balance, it comes under current liability. That's where the company owes its agents money. This is 110. And we also have outstanding premiums, which is 240. So the total here comes to 450. Total is 450. Next, we have Schedule 13, which is current liabilities. Now, in the current liabilities, we have identified three. One is sundry creditors. Sundry creditors is 750. Then we have outstanding expenses. Outstanding expenses are 250. And we also have claims outstanding. We also have claims outstanding, which is 350. So total of this comes to 1,350, I think. Yes, 1,350. Then we have Schedule 14, which is provisions. Schedule 14, which is provisions. Now here we just have one item, reserve for unexpired risk, or we can say provision for unexpired risk. Now please don't confuse this again, because the word reserve is used, it does not come under reserves and surplus. This is a provision that is being made against the premiums. Okay, in case there's any claim against those premiums, there's a provision being made. So we call it reserve for unexpired risk. Fire, here they've given two types, fire and marine. Fire and marine. Fire that is given is 1,600 and marine is 1,000. So the total reserve comes to the total comes to 3,000. And finally, the last one I think is Schedule 15. Okay, now we don't have anything under Schedule 15, so we don't need to prepare Schedule 15. If you don't have an item under the schedule, no need to prepare, but you need to mention it in the in the balance sheet in the format. Okay, so we don't have anything. Now we are going to do that working note. Okay, before I go to the working note, any questions till here? Any item that, any schedule that somebody wants me to explain again? Any questions before I do that slightly complicated adjustment? Any questions? Any questions? Any questions? Okay, fine. So I will do that small working note. This is working note for fair value change account. Fair value change account. Now, what they've given to us, and I told you this fair value change account is comes into the picture when there are fluctuations in investments, values of investments, differences between the book value and the market value, and that is what we have in this problem. Now, if you see the total investments, we have two investments: investment in uh, government securities. Please pay attention to this: investment in government securities. Investment in government securities, which is 2,400, and we also have shares and debentures of joint stock. companies, of joint stock companies, which is 1,500. Shares and debentures of joint stock companies. So basically the value of the investments that we are showing, the total value is, if you put this two together, the total value is, if you add this, you get 3,900. Okay, so the book value of the investment, these are figures mentioned in the you can say the details that are given to you. So basically that's the book value of the investment. The book value of these investments is 3,900. But what they've given you is they've also told you the market value. Okay, so and the market value that is given to you is 36 lakhs. The market value given to you is 36 lakhs. I'll just write it here just for you to understand. Market value of investments. Market value of investment given is 36 lakhs. Now why we can't take it as 36 lakhs? We need to strike off these three zeros. Okay, so we get it as 3 less market value of investments less market value of investments. We have 3 6. Okay, market value. So basically the book value is less than, the book value is more than the market value. So basically it becomes kind of a loss. Okay, so it becomes a loss. So how are we going to show this now? So how much is that loss? That loss, if you see, the book value is 3,900, market value is 3,600. The loss is basically 300. The loss is basically 300. Okay, so what have I done? What I have done till now, I've taken the investments that are given to us, I've shown it at book value, and then I've compared it with the market value. And if you compare it, the market value is less than the book value. So basically, right now, the investments, you have made kind of a loss. If you want to sell the investments, you will make a loss on the investments. And how much is that loss? 300. Now, to compensate for this loss, okay, to compensate for this loss, we have something called as investment reserve. Okay, to compensate for this loss, we have something called as investment reserve. And right now, how much is there in that investment reserve? If you check the amount of investment reserve, you have 200. You have 200. You have 200. So basically, you had a loss of 300, but to compensate for this loss, you had a reserve. Okay, to provide for this loss, but in that reserve you have only 200. So the actual loss that you have made, the actual loss that you have made is 100. The actual loss that you have made is 100. Okay. So actual loss that you have made is 100 rupees, and this loss is shown in that fair value change account. This loss is going to be shown in that fair value change account. Okay, now sometimes that fair value change account can show a profit as well as a loss. Okay, that can show a profit as well as loss. In this problem, it's a loss. How did we get a loss? The book value of the investments is 3,900. The market value is 3,600. The actual loss face is 300, but then we realized we had an investment reserve. So we kind of try to reduce the loss, and the loss actually comes down to 100. Now, coming to the investments here, again, the book value is 3,900, but the actual value is basically the market value. Okay, the actual value of the investments is market value. So when we are showing it, we can't show it at book value, but we have to show it at market value. See, whenever the investments are shown, it's normally book value or market value, whichever is lower. So we need to show the investments at the market value, which is 3,600. Okay, and the difference between the two, the book value is 39, market value is 3,600. The difference between the two, that is 300, is shown as fair, or you can say less. The adjustment is made towards fair value change account. Fair value change account. See, when we are showing it in the books, we can't show it at a wrong value. If we show it at 3,900, that means we're showing it at a wrong value because actually the value of the investments is 36. So when we're showing it in the balance sheet, we need to show it as 36. But when what happens to the difference? That difference is adjusted towards the fair value change account. And if you see this, if you check this fair value change account, okay, you actually have a difference of 300. But how have we compensated and brought it to 100? Through the investment reserve. Through the investment reserve. Okay, I will go. I will complete the balance sheet and then again come to this. It will make a little more sense once I complete the balance sheet. So just let's start with the balance sheet. Let's see how this fair value change account looks in the balance sheet. So we start with the first one, that is sources of funds. Sources of funds. Under that we have share capital. Under that we have share capital. Okay. So if your share capital is 1 and the amount of share capital, if you check, is 2000. Share capital is 2000. Then we have reserves and surplus. We have reserves and surplus. The amount of reserves and surplus is 1900. And then we have borrowings, which is 3. And the borrowings, I think, are 3000. Sorry, I've got the schedules all. It's 5, 6, and 7. Sorry. Borrowings are 3000. Now, besides this, we also have something called as fair value change account. Okay. Now, I want you to answer certain questions. All these balances this side, the share capital, reserves and surplus, borrowings, are they debit balances or are they credit balances? This is something you need to know. All these balances here, are they debit balances or are they credit balances? Can anyone tell me? Are these debit balances or are they credit balances? These three amounts I'm talking about. Are they debit balances or are they credit balances? Debit or credit? Quick, quick, quick. It's a very simple question. This is the basics of the balance sheet. Are these debit balances or are they credit balances? Nobody knows? Share capital. Capital is a debit balance or a credit balance. Reserves and surplus. Debit balance or credit balance. Borrowings. What are these? Debit balances or credit balances? This is basically a liability side of the balance sheet. Liabilities are debit. Liabilities show debit balances or credit balances. Students, have you all understood the question? I'm just asking a very simple question. I'm asking you whether these are debit balances or credit balances. No reply? These three, share capital, okay, fine. The other, okay, reserves and surplus, borrowings, forget about that. Share capital, the most simplest thing. This is the first item in your balance sheet on the liability side. Does share capital show a debit balance or a credit balance? Okay, forget about this. Capital, does capital show a debit balance or a credit balance? And capital, is it a liability or an asset? Okay, let's go to a simpler question. Is capital a liability or an asset for the company or for the business? Is capital a liability or an asset? Is capital a liability or an asset? We are going to something that are real fundamentals of accounting. Nobody's answering. Capital is, yes, capital is a liability. Very good. Capital is a liability. Why is it a liability? Because you owe somebody money. If it's share capital, it's basically money of your shareholders. The business owes that money to its shareholders. Similarly, what about borrowings? Borrowings are also a credit balance, because you have borrowed money from banks or from financial institutions, or you raise funds and you basically owe those people money, so it becomes a liability. So basically all these balances and liabilities always show credit balances. All these balances are credit balances. Now why am I asking you this question? Okay, now coming to this fair value change account, it's shown with all these credit balances. It is shown with all these credit balances. So let's see, coming back to our fair value change account, what it says. Okay, this is calculation for fair value change account. 3,900 is the book value of the investments. 3,900 is the book value. 3,600 is the market value. So basically 300, is this a gain or a loss? Is this a gain or a loss? 300 here, is it a gain or a loss? Very good. Losses show debit balances or credit balances? These losses show debit balances or credit balances? Do losses show debit balances or credit balances? So what is the rule of the third rule for nominal accounts? Debit all the expenses and the losses and credit all the incomes and gains. So losses show debit balances or credit balances? When it's a loss, is it a debit balance or a credit balance? When it is a loss, is it a debit balance or a credit balance? Simple things. Yes, it's a debit. Looks like only Vinefra has her fundamentals, knows her fundamentals in accounting. She's the only one answering. So basically, loss is a debit balance. Okay, the loss is a debit balance. Reserves are always credit balances. What are reserves? Basically, they are accumulated balances. Okay, they are accumulated balances. If you see reserves and surplus, though we don't take this under reserves and surplus, we adjust it here. Reserves are always credit balances. Okay, it's like an accumulation of a fund. It's like an accumulation of a fund. Now, my question to you is, if 300 is a debit balance, 200 is a credit balance, what will this 100 be? What will this 100 be? Will it be a debit balance or a credit balance after making that adjustment? What will this 100 be? A debit balance or a credit balance? 300 here is a debit balance. Okay. 200 is a credit balance because it's a reserve. 300 is a debit balance because it's a loss. So finally, what will this 100 be? We will end up with a debit balance or a credit balance. Quick, quick, quick. 300 is debit, 200 is credit. 100 will be debit or credit? Okay. Vinefra, you're right. Bridget, 300 is debit, 200 is credit, and this 100 will be debit or credit. It will basically be a debit balance because your debit is higher than your credit. Your debit is higher than the credit. So basically, this 100 rupees is going to be a debit balance. This 100 rupees is going to be a debit balance. Now, why am I doing all this? Why am I doing all this calculation, asking you what is debit, what is credit? So 300, which was a loss, is a debit balance because it's a loss. 200 is a credit because it's a reserve. So we have adjusted this reserve to reduce our loss. But finally, we still remain with a loss of 100 rupees. Now, when we are showing it here, when we are showing 100 rupees here, okay, when we are showing 100 rupees here, I can't just show 100 rupees like this, but I'm going to put 100 rupees in the bracket. Why am I putting 100 rupees in the bracket? Because all these are credit balances. All these are credit balances, but this 100 rupees is a debit balance. How I know it's a debit balance? I've calculated it here. This 100 rupees, if I don't put it in brackets, what am I going to do? If I don't put it in brackets, what will I do to get this total? I will put all these together. But I can't put all these together because 100 rupees here is actually a debit balance. Now, this fair value change account can either be a debit balance or a credit balance. If the investments, if that market value here was more than the book value, it would have been a credit balance. If the market value was more than the book value, it would have surely been a credit balance. Okay, so this fair value change account can either be a debit balance or a credit balance. So right now it's a debit balance. That's why I have to put it in brackets. If I don't put it in brackets, when you're adding all this, if I had not put it in brackets, you would have made it 2000 plus 1900 plus 3000 plus 100. Since I put it in brackets, how are you going to show it? 2000 plus 1900 plus 3000 minus 100. Is that clear? Okay, so please remember this. So fair value change account can be a debit as well as a credit balance. Fair value change account can be a debit as well as a credit balance. Okay, and how I've derived all this is through this calculation. Fine. So let's go ahead because we need to finish this problem. I will come back in case there are questions towards the end of the problem. I will address those queries later. Okay. So let's just come to this. So we get the total here. We will do the total a little later. Now we come to application of funds. Application of funds. So under this, the first thing that we have is investments. Then we have loans, and then we have fixed assets. I always put these things together because it's easier to remember it that way. 8, 9 and 10. So let's just see these amounts. 8, 9 and 10. Investments are the book value, the actual value of investments is 3600. Loans are 2000 and fixed assets is 1500. So investments are 3600. Loans are 2000 and fixed assets are 1500. Okay. Next, I'm going to come to my bifurcations now. My next thing is current assets. Current assets. Now, under current assets, I have two items. Okay, I have two items under current assets. I have cash and bank balances. I have cash and bank balances, which is 11. And I also have, I'll put this here. Cash and bank balances, which is 11. And I also have advances and other assets. Advances and other assets. Okay, now we need to check our totals here. Cash and bank balances is 3600. Advances and other assets are 450. This is 3600 and this is 450. This is going to give me my sub total A. Okay, now when I'm calculating my subtotal A, I'm not going to take this 3 into consideration. It's just 3600 plus 450. That is going to give me 4050. Okay, now how did I get my subtotal A? It's basically 11 plus 12. This will go with this we will take in the final total towards the end. Okay, then I move on to current liabilities. Current liabilities, and then I have provisions. Current liabilities. So current liabilities is 13 and provisions is 14. Now current liabilities that are given, how much have we calculated current liabilities? 1350 and 3000. 1350 and 3000. Current liabilities are 1350 and 3000. Okay, so that gives me my subtotal B. That's going to give me my subtotal B, which is 13 plus 14. And 13 plus 14 is going to be 4,350. Okay. Then what do we do? Then we calculate something called as net current assets. And how do I get this net current assets? Is basically minus A minus B. And what is A minus B here now? A is 4050 and B is 4350. Okay, now again I'm going to come to credits and debits. Current assets, this 11 plus 12, is cash and bank balances, advances and other assets. Basically, this total of 4050, is it a debit balance or a credit balance? Quick. Current assets here, this 4050, 3600 and 450, is it a debit balance or a credit balance? Both these items come under current assets. Current assets show debit balance or credit balance. Yeah, assets. Assets show debit balance or credit balance. Assets show debit balance or credit balance. All assets show debit. If here you said liabilities show credit balances, if liabilities here show credit balances, what do assets show? Investments, loans, fixed assets, do they show debit balances or credit balances? I think I really need to give you all a class on your fundamentals. These are assets, cash and bank balances. Do they show debit balances or credit balances? They are assets. All assets. What is the rule? All assets show what balances? Debit or credit? Okay, look at the balance sheet. The liability side shows credit balances and the asset side is basically debit balances. All items like your fixed assets, investments, loans can be credit as well as debit. These loans are loans which are given. These are all debit balances. All assets, please remember these rules. All assets show debit balances. All assets show debit balances. These rules don't change. All assets show debit balances. All liabilities show credit balances. All liabilities show credit balances. Please remember these rules. Okay. Now we have these two. These are assets and hence they show debit balances. So these two, this 4050 is basically a debit balance. This is just for you to understand, is basically a debit balance. What about current liabilities and provisions? 4350. What about current liabilities and provisions? Is it a debit balance or a credit balance? They are liabilities. This is going to be basically a credit balance because they are liabilities. Now, what is my question here is A minus B. Now, A is this and B is this. So, if I minus 4050 from 4350, I basically get 300. Okay, now pay attention here. Your debits are 4050, and credits are 4350. So, basically here the credit is more than the debit. The credit is more than the debit. And here when we're talking about this application of funds, all these are debit balances because they are all assets. Investments, loans, fixed assets, they are all debit balances. So if I show this just like this, okay, it's basically a credit balance. How do I know it's a credit balance? How did I get this 300? Your debit is 4050, credit is 4350. So basically your credit is higher than your debit. Sometimes debit may be higher than the net assets, current assets may be more than the current liabilities. That can also happen. That time your debit is more than the credit. But since in this problem the credit is more than the debit, what will I have to do is I'm going to put this 300 in brackets. Same principle as this. This is a credit among debits. This was a debit among credits. This is just for your understanding purpose. This was a debit among credits. But this is a credit among debits. This is basically your asset side. So why am I putting in this in brackets is if I don't put it in brackets, what will I do? I will take 36 plus 2,500 plus 2,000 plus 1,500 plus 300. But I can't add 300. I need to minus 300 because 300 is a credit balance. Okay. So because these liabilities are shown under application of funds, we need to be a little careful. They are shown under application of funds, but minus it from the current assets. To be minus from the current assets. So we are calculating actually net current assets minus current liabilities. But right now, unfortunately, our current liabilities are more than the current assets, and that's why we need to show this as a negative balance. Okay. In the next problem, when I do the next problem, it's a little simpler than this. I think things will be a little more clear. Okay, next problem, current assets are going to be more than the current liabilities. So we won't have to show this in brackets. But right now we are showing this in brackets because this is more than this. So I'm going to go direct to my next item. Miscellaneous expenditure. Now we don't have anything under this miscellaneous expenditure. But why I'm showing it is because it has a schedule number. Okay, I don't have anything. I'm going to show it only because it has a schedule number. And then we have another item called debit balance in profit and loss account. Again, we don't have the debit balance in profit and loss account, but I have to show it because it's part of the format. And then I come to my total. Then I come to my total. Okay. Now, when I'm showing this total, how am I going to get this total is basically 8 plus 9, 8 plus 9 plus 10 plus net current assets plus 15, okay, plus debit balance in P and L account. I've just elaborated on this just to make it a little more clear. You don't have to write all this. This is just so that you can understand it. Okay. Now, what am I going to do here is debit balance in P&L account. Now, I'm going to see what are this 8. Now, my 8 here is 3,600. Okay. 8 here is 3,600. 9 here is 2,000. 10 here is 1,500. Okay. Now, net current assets. Finally, my net current assets is a negative figure. So, even though I've said net current assets, now when do I add it? Basically, when my current assets are more than the current liabilities. But here, what is happening? My current liabilities are more than the current assets. So, I cannot add this. But I'm going to minus it. And that's why I put this 300 in brackets. Okay, because this 300 needs to be minus. Plus 15, schedule number 15, we have nothing in 15. Nil plus nil. We have nothing in 15. Nothing in 15 and nothing in balance in profit and loss account. So basically my balance sheet total will be 36 plus 2 plus 15 minus 300. If you do this calculation, you'll get 5,600, 6,100, 7,100 minus 300. We get 6,800. And if you check here also, the balance will be 6,800. You can check 2,000 plus 3,900, 6,900 minus 100 will be 6,000. I know it seems a little complicated, okay, since it's the first problem, but as we do the other two problems, things should get I think you should understand it a little better. So basically, this is how the balance sheet is done. It's slightly complicated. Why it's complicated? Because they show these current liabilities and provisions here instead of showing it here. Okay, but that is the format of the balance sheet prescribed for insurance companies. Now, what I want you to do is